KKR is seeing opportunities in high-yield bonds and is selling some floating rate debt as the Federal Reserve pauses interest rate hikes. Now, we have Bloomberg's Olivia Raimonde here with us to talk more about this story. What I don't understand here is floating rate was the name of the game until now. So what's changed?
It's a really important and interesting question, Shonali, and thanks for having me on. If you go back to the beginning of the year, people were talking about moving out of floating rate then because they were expecting a scenario where maybe we'd be seeing rate cuts at this point in the year. As you were just discussing with Liz, that hasn't really materialized, and that longer duration trade and some of the fixed income trades therefore haven't done so well. What KKR is saying is now they think is the right time. Earlier this year was too early, and they stayed overweight leverage loans back then. They're still overweight now, but this is the time where they really are seeing that the Fed is not going to move materially higher from here, and this is where they want to more meaningfully move into fixed rate debt.
Well, Olivia, let's build on that, because this was referencing the fact that it seems like some people are getting a little wary of putting out projections on what the Fed does from here on out. But I guess if they're quite literally putting their money where their mouth is, this is a pretty strong call and belief on where we are in the tightening cycle.
Yeah, I think essentially what it is saying, and this echoes exactly what Jamie Dimon was saying, is that we might see another 25 basis point hike. We don't exactly know where rates are going to go at the long end. No one has a crystal ball. But KKR is saying right now they have a stronger conviction that the Fed is much closer to the end of that hiking cycle than at the beginning of the year, when many other money managers, frankly, piled in perhaps too early into longer duration and fixed income.
How much of this, Olivia, is a worry about default rates starting to inch higher? This idea also that more downgrades, more fallen angels might be on the horizon.
So the market has been extremely resilient. As I know you know, we've seen bankruptcies and distress and defaults go higher, but it has not been to the level that I think the market was expecting when I was talking to my sources, say, a year ago. And that is what has helped the U.S. leverage loan trade so far this year. I mean, we're talking double-digit returns. It's had a phenomenal year. But that is the question, though. At what point are we going to get this slowdown? And when is it going to materialize, and where? And all of my sources continue to point to the leverage loan market as the area of weakness.